Okay. As Cameron has already mentioned in his presentation, we have seen, major policy shift throughout 2025, and that has plunged, the world into heightened uncertainty. In the specific case of trade, I think it is fair to say that the shift have been exceptional, whether in terms of scales, scope, or speed. And within trade flows, particularly merchandise trade has been especially in the spotlight. Now, beyond tariff, there are also more profound multidimensional shifts that have continued to reshape the global trade. We have sudden shock of all kinds, but also longer-term transformation that both, reflects the complex interplay of macroeconomic reorientation, which is significantly influenced by a stronger government footprint, at least in some economies, also inward-looking industrial policy, again, in some major developed economies, and together with geopolitical tension and rapid technological change. So clearly, I won't be able to address in detail all those dimensions today within my 45 minutes for this presentation. But what I plan to do with you is to first look at the recent trade dynamics and to say a few words about the future, the near future perspective, and then to basically move to what is called the financial channels of trade, which is a topic that, in our view, have received neglected attention. And as I will try to convince you, there is a need to look at that into more carefully, because it's something that is important. But I will keep that for the second part of my presentation. Now, having mentioned many ongoing transformation, if you are interested in that, I would strongly encourage you to look at some previous trade and development report, including the one for which Cameron has already made some commercial, which is the one of last year, when we discussed basically the need to consider maybe a slightly different development strategy away and to depart a little bit away from manufacturing export-led growth and to focus more on services, including non-tradable services, because that's ultimately where the bulk of the population usually could find unemployment. So if the goal is to increase the standard of living for the majority of the population, especially in the developing country, there is a need to focus also on those particular sectors. But again, if you are interested into that, look at last year's report, and I'll be happy also to discuss that in more detail during the Q&A, or at other point in time. We always remain available to you throughout the year. No, so that's for the commercial. Now let's move back to my presentation, and let's start to look at, to put things in perspective and to look at the evolution of world trade. So that's a picture that shows basically the evolution of merchandise trade flows in what we call the real term. That is, once we have, absorb or control, so to speak, for the various price movement. So here you have a series that basically depict how, if we look at the number of goods, so to speak, that have been traded over time, how that has evolved over time. And clearly, since 2020, what you can see is that there were basically four main phases. The first one that you all know is linked to the COVID crisis, when we had a very steep decline of world trade, but then a very sharp recovery that we call sometimes a V-shaped recovery. And then there was some relative dynamism of merchandise trade overall, partly because, as you remember, during that time between 2021 and the first half of 2022, there was some shift in consumption patterns towards durables goods at the time where high contact services activities were much more limited, and that basically shift of expenditure was beneficial to world merchandise trade. Then we have some normalization of trade, of consumption patterns, and as a result, merchandise trade grew, although at a more subdued rate. So you can see that actually the line here is actually, the slope is actually is flatter, and that reflects basically the world trade growing more or less at pace with the growth of the overall economic activity. And then towards the, more recent period, and especially, the last quarter of 2024, but then mostly the beginning of this year, there was again a regain of dynamism when we look at international trade. And that's somehow a little bit surprising, because at the same time we have had probably the strongest trade policy shock, at least since I think it's fair to say since the Second World War. But yet we had some dynamism of trade activities. Now, one of the big reasons beyond that rebound or regain of of trade activities worldwide is actually due to what happened in the US, because when it became clear that there will be a significant increase of tariff, there were actually lots of front-loading that took place. And here you can see, I should have maybe started with this, but those lines, they represent basically trade flows and through index number whose value of 100 reflect the level, the average level of 2021. So what happened also, if we look at the specific figure of the import of the United States, you see that it has, within a few months, increased by 30%, which is something which is really outstanding and not at all usual in real time. So that created a kind of spike in world trade. But the key question is whether or not this will last, and obviously we see that as a transitory factors, and that's why we are somehow more cautious for what will happen next. Now, an interesting exercise is that if you look at the evolution of world trade at the beginning, during the first half of 2025, compared to the same period in 2024, world trade grew at more than 4%. But if actually you net out the effect that is driven by this temporary spike in US import, you will find that world trade will have increased by only 2.5, maybe 3% throughout the first semester of this year compared to last year. So deducting basically that temporary effect will give actually a less rosy picture. Now, as it is often the case with aggregate figure, it masks significant heterogeneity across economies and country group. So here you can see that actually if we look at advanced economy versus emerging market, and here the terminology is actually given by the Netherlands Bureau for Economic Policy Analysis, because we rely on their series for this analysis in real term. What you can see is that, especially after 2023, the trade activity has been much more dynamic in emerging markets compared to the advanced economy. In advanced economy, you see that apart from the very recent months, exports have been overall rather flat since 2023. And for import, it has rebounded, though if we look at levels, we are pretty close at the moment to what were the import level in 2022. So not much long-term progress on that front. And by contrast, the the emerging market, also import, have grown much strongly, and I will get back to that in a second. Now, I don't want to bombard you with too many charts, but here you just have further disaggregation for the developed economy, what is happening there. And again, you can see that actually outside the most advanced Asian economy, excluding Japan, the export have not really took off on this 5 years time horizon. And similarly, to put things in perspective, you have on the right-hand side the very sharp increase of the US import with the dark blue line. And clearly that's something which is also quite unusual. Now, so the overall takeaway from that slide and the next one is that actually outside developed and developing Asia, and apart from some temporary episode, there hasn't been a very strong organic development of trade in recent years. In the case of the euro area, you can see that that's the light blue line. The import and the export have been relatively flat since a couple of years now. And yeah, that's, I think, what you should have in mind for now. Now, turning to developing economies, again here we see a pretty strong dynamism in the export of China, that's the blue line, and also in the rest of Asia, in the rest of emerging Asia, which is the light blue line. There are also recently, but that's a more recent phenomena, some recovery in Africa and the Middle East export, although from an historical perspective, they remain below the level they reached in at the end of 2022, early 2023. And when it comes to import, well, they have rebounded significantly here on this chart, but that's partly due to a base effect that is not depicted here. And also what we can observe is and that's important, I think, for the export prospect of many developing economies, that the import of China, which is again the dark blue line on the right, that has remained relatively flat in recent years. So that, unlike in the past when we had a very strong demand emanating from that economy, because of the somehow reconfiguration of the Chinese economy, it has become less. Its import has become more subdued in recent years. Okay, so that was to give you a very brief snapshot about recent trade flows in merchandise. Now, what we can say beyond the very short-term dynamics is that there has been, as Cameron already mentioned, some reorientation of trade flows, and the reconfiguration of supply chains is also something important to monitor. At the moment, those evolutions are quite difficult to track because you have lots of noisy data. But still, what we can say is that there seems to be some reorientation of Chinese export towards Africa and many countries in Asia, especially from ASEAN. And at the same time, obviously, the export from China to the US have declined. Now, well, you might remember that a few years, in recent years, there were lots of discussion regarding friendshoring and nearshoring trends. Our preliminary analysis is that those trends have somehow stalled or even sometimes even reversed, depending how we characterize those friendshoring and nearshoring movement in the late 2024 and early 2025. And relatively, intention in certain countries to repatriate industrial production have yet to materialize on a broad scale, partly because factory relocation and supply chain restructuring, can sometimes span a decade or more. So in fact, it's not something entrepreneur can do from one day to the next. And given the extremely high uncertainty that currently prevails, we believe it's not really conducive to, for this major supply chain shift to happen. So what we have observed is that in many cases, actually, many entrepreneurs have adopted a more wait-and-see approach strategy, given the very high uncertainty that prevails at the moment. So that's just to say that, and that might be one of the reasons why we haven't seen such a very strong reallocation and reconfiguration of supply chain for the time being. Now, obviously, we don't really know how what will be the future of the trade policy in the years ahead. There has been recently some positive news after the head or the president of the United States and the Chinese leader met, but still there is room. Caution is still warranted, and oops, sorry, where I am now. And in the long run, there is still lots of uncertainty. Now, turning to trade in services, that's also it becomes more and more an important sector of international trade. Although merchandise trade remains really the bulk of international trade so far. But what we can say there is that when it comes to services, there was a slowdown during the first quarter, but that's partly due to an exchange rate effect. And then trade in services bounced back during the second quarter. Overall, if we look at the on-year growth during the first half of 2025, the entire category of what we call trade in services, which encompass, in fact, lots of different types of activities, it has grown by approximately 7%. So a stronger footing than what we observe for merchandise trade. Yet there are basically lots of heterogeneity behind that aggregate figure. In particular, international transport has been somehow less dynamic, but for the rest, like international travel, and that's partly linked to a recovery effect, but for also all kind of other international services, they grew at about 10%. And when we look at what happened at the regional level, we saw that the expansion of services was stronger in Asia and in Latin America compared to what happened to Europe and Northern America, even though those two developed regions still account for the bulk of global services. Now, when we look more specifically at the two largest services providers among developing countries, which are China and India, which is not really surprising given the size of their economy. In China, trade and services grew by 17%, and in India, another double-digit figure of 10% during the second quarter of 2024. Fine. So, however, we are somehow a little bit, we don't think that will necessarily, this very strong growth in China will be sustained, partly because it is linked to a very strong rebound of travel and tourism activities. And we don't see that being able to be sustained in the long run. In India, by contrast, it relates much more to the growth of finance, intellectual property, telecommunication, and so on and so forth. And that's why we believe that India is more likely to continue its relative strong growth in that sector in the years ahead. Now, how much time? Okay. When I look, when turning to tariff, well, I think you know more or less the situation, but here I just wanted to propose, I mean, two different metrics to try to capture how these have evolved in the context of the United States. Depending on the metrics you use, and I'll be glad to comment on, to come back to that during the Q&A, we see that actually the impact of tariff was relatively important. A kind of conservative estimate shows that it increased by at least 10% overall for the United States, because they have many carves out and provision in linked to the tariff announcement that have been made. But if you take if you try to compute the average effective tariff rate, which is basically to apply for each line, each tariff line, the consumer basket of the United States of last year, you will find that actually the effect gets closer to 20%, which might be a kind of upper bound because it doesn't allow for substitution effect and so on, but I don't want to go too much into the detail here. Now, in many respects, I think it's fair to say that the world economy has ventured into uncharted territories, and adding to the challenges we had to try to understand what's going on, we have numerous recently release of data series that have been distorted by transient factors, which makes, I mean, the overall interpretation sometimes more precarious. And I think under such condition, it is both prudent and also necessary to exercise caution regarding what can be realistically and accurately predicted. And that's why in the Trade and Development Report, we don't have a very precise point estimate for what will happen next year, because there are way too many uncertainties, but we just give a kind of range of what we believe will happen. Now, for the prevision of 2025, it's actually easier because we have already lots of monthly trade figures, at least for the first months of the year. And if we expect trade to slow down, partly because of the fading effect of the front loading, and also the tariff hikes that will become more significant in practical terms, we expect the global trade in goods and services in 2025 to grow about 4% in 2020 this year, and for next year we think that the global trade in goods and services will slow down a little bit, probably and be more or less at pace with the global economic activity. So more towards like 3% probably. Now, obviously, again, beyond the headlines number, we see significant heterogeneity across firms and countries, and we are particularly concerned to what will happen to the small enterprises and the low-income economies, because they are much more vulnerable, as they are usually less able to respond to the unpredictable trade environment that characterizes the world economy right now. And this vulnerability is also compounded by persistent uncertainty surrounding the extension of trade preference program, the specific of the transshipment condition, and finally the evolving rules of origin framework in many, or at least some large developed economies. So that means that these uncertainties about the future of the market access condition continue to undermine strategic planning. And that's also deter investment and limit ultimately the meaningful participation of those economy in the international trade and global supply chain. So clearly, in this challenging time, it is imperative for all stakeholders to monitor closely the policy shift and to try to adapt the sourcing and the market strategy accordingly. In this regard, UNCTAD remains actively engaged and provide regular update on its website with the recent policy development and also some analytical insights. So I invite you to continue monitoring that. Now, for businesses, I mean, the path forward involve probably greater supply chain diversification to mitigate the geopolitical and climate-related risk. There is also a need to invest in digital, or to invest more in digital tools to enhance basically the agility and the resilience of the firm. For the policymaker, there is probably a need to try to counter the fragmentation, or at least to soften it, and that can be done by reinvigorating multilateral or regional cooperation as a second best. And given the projected dynamism of digital deliverable services relative to merchandise trade, we believe it is essential to strengthen the digital infrastructure in developing countries to narrow the persistent gap with advanced economy. And so this can include targeted investment in connectivity, skills, and regulatory framework. And in parallel, there is a need to align trade and climate objectives to ensure long-term sustainability. Now, equally important for the future of trade is the need to move beyond immediate concerns surrounding tariff, and that's basically the purpose of the next section, which turns to an under-examined topic that is what we call the interlinkages between trade and finance. And I will now move to that. So it's actually mostly an innovative empirical investigation that we have conducted. It's still, we haven't really understood necessarily all the specific details and what is all the channels that are behind what I will present here. But I think it calls for further investigation, and because it focuses basically on the interlinkages that we observe between international macroeconomics and also global finance. So to give you a small break, what I would like to do with you now is to just embark in a very quick survey that you can actually find if you use your smartphone and you scan this QR code. And there will be just a single answer. There is no, just a single question, sorry. There is no wrong answer, but you will discover the question, and that will allow me to hopefully look at your result. So you have all the QR code, and are you able to scan it and to answer the survey? Yeah? Okay, so just give me 1 second while I go to the result. Sorry? Yeah? Do you all get that, or do you have the first question that explains?
No question?
Okay, so sorry for that. We tried that last week and it worked well, but that's always the problem when you do things live. why it is like this? Okay. Well, okay. So I asked you what the question is. It's basically, imagine that you have an appreciation of the US dollar. Okay, so let's move away from technology. So the question was the following. How do you anticipate the export of your country to vis-a-vis the United States to perform when there is an appreciation of the US dollar? Okay, so the US dollar appreciates. Do you expect basically your export to increase, to decrease, or to remain more or less constant? And the second question that was linked to that one is that what was the reason for that? Okay, so have you already, do you want me to repeat the question or is it clear? So again, an appreciation of the US dollar.
Depreciation of your local currency.
Yeah, or if the US dollar appreciates vis-a-vis your local currency, what do you expect for your export to the United States? So and again, there is no wrong answer here, but who believes that it will actually increase the export of its country? Can you raise your hand? So we have 2 people, 3. Okay. For the other, what do you expect? That it will remain more or less, it won't create any effect, or do you expect your export to actually decrease? You expect your export to decrease when the US dollar appreciates? Okay. And what would be the mechanism behind that?
Why would the exports increase?
So, for instance, you're in Djibouti, you export some product to the United States, the US dollar appreciates. Do you think the Djibouti exports will increase or decrease?
S'augmenter, donc le prix sera en hausse, comme le prix sera en hausse, et donc les autres produits seront plus compétitifs sur le marché des États-Unis. Donc comme le prix a augmenté, donc d'autres produits seront plus compétitifs, donc comme le dollar a augmenté. Donc.
Sorry for that. Okay, so I was saying that there was a kind of competitiveness issue, which is basically that when the dollar appreciates, the US consumer, for them, it becomes, cheaper to source even more goods from abroad. So that will tend to boost, we believe that will tend to boost the export of the other countries, especially vis-a-vis the United States. Now, and that's the typical, competitiveness channel that all students probably have heard about in economics when they take a course of international trade. But actually, an important thing that happened in reality that is here, that has been already emphasized by those 2 authors, Valentina Bruno and Young-Sean Chin from the BIS, is that when the dollar appreciates, here we have the world trade, but we can repeat that experience for the US import, and we actually see, which is quite counterintuitive, that it tends to decrease. So, and that's specifically because in practice, what happened is that we have something which is called the financial channel of trade, which tend to outweigh the positive effect of the competitiveness. And that's a little bit what is the motivation for the topic I will now discuss in more detail with you for the rest of my presentation, which is basically to try to understand that neglected dimension. So again, it's an empirical investigation. It is, to some extent, still a little bit preliminary, especially when it comes to very detailed policy conclusion than one can draw, but at least in terms of what is happening and for the fact, I think it's important, and we have already devoted and found some interesting things that I would like to share with you today. So, in a nutshell, as I said already, when economists analyze the drivers of international trade, they very often look at what is called the real factors, or also the trade policy aspect of it. And that's somehow, in a sense, normal, because clearly, productivity, trade is linked to production, and productivity, technology, factor endowment, geography, all kind of things like that are linked to what is called the real factor, have a clear effect on trade. Yet, little attention has been paid to the financial and monetary determinants of trade, and that's a little bit surprising because, as Anastasia already mentioned at the beginning of this course today, outside barter, in fact, any cross-border exchange of goods involve at least a financial transaction. Okay, so to take a basic example, if you basically have a shipment of German machinery to Brazil, that will not be feasible without some kind of Brazilian reals being transformed via finance into euro or dollar to settle that transaction. So, in other words, international trade will not go very far without credit and other financial transactions, though those aspects are very often neglected. And I will get back to the various dimensions that we want to address with that, but there are basically three main points I would like to draw the attention on. The first one is the credit provision that is essential in trade. The second one is all the aspects linked to the currency exchange and also the hedging instrument that help to manage the risk of currency fluctuation. And finally, there is also another type of dimension, of financial dimension, that relates to what is called the risk management tools. Again, here, insurance and credit guarantee and so on, because we know that with trade, because there is quite a delay between the payment and the export of goods. There are clearly some risks that my counterparty risk that can be important, linked partly to geopolitical disruption, and we need, proper financial tools to manage all that. So, in the literature, there were already in the 80s, albeit no directly focusing on trade, some interesting research that were done by Bernanke and others that link to the financial accelerator. Again, that's not really in the trade context, but that basically explain why, when you had some change in the monetary policy, it has some spillover effect, and there are some indirect effects that tend to basically accelerate or reinforce basically the pure monetary policy instrument. So it's a dimension that we look at in our research. Although there were, after the global financial crisis, lots of interest that focuses on trade finance. Now, what we did for this research is to look at something which is slightly broader, and that relates to the research that was done by Ellen Ray and some co-authors over the last decade, that basically look at what is called the global financial cycle. So what is the global financial cycle? In a nutshell, is basically the common fluctuation in financial activities that are measured on a broad range of variables. And as you will see, it is in fact associated sometimes with surges and retrenchment in capital flows, boom and bust in asset prices, and also sometimes financial or economic crisis. Now, And I will get back to that in a second, but when we look at the global financial cycle, what the research has shown is that it originates mostly in advanced economy, and it transmits across border through United States monetary policy, also the risk appetite of the financial actors, and finally the exchange rate movement, especially vis-à-vis the dollar. Now, before I move back to the global financial cycle from a more theoretical point of view, to motivate that discussion, what I would like to do is to show you, if you look at the data from Ellen Ray and her co-author, that's basically the evolution of the global financial cycle. Everything is done in terms of deviation from the long-term average. That's why the unit are the standard deviation. But you have basically, that's one, the way that they plot basically the global financial cycle, which in practice, they extract a kind of common factor that is that appears in more than 800 asset price time series. Okay, so I don't want to enter into the detail here, but basically you extract, the whole idea here is to extract a common signal from those 800 asset prices time series that they consider over this time period. And as you can see, so that's a pure, basically, statistical exercise, but it is interesting to see that there are some up and down that sometimes coincide with crisis, and I will get back to that in a second, but that's for the time being the global financial cycle evolution. And now turning to international trade, if you look at the evolution of world trade over time, that's basically and here again, taking the same metrics I used before, which represent, world trade by an index whose value of 100 equal to the average global trade flows in 2021. We see that over time it has increased, and again, there were some fluctuation around the trend that is depicted with the dashed line. Now, in econometrics, if we want to look at the relationship between two series, we have to ensure a certain number of property. One is that the two series have to be stationary. So what we did here is just to detrend world trade, which is basically subtracting the trade flows that we observe here, the solid yellow line by the dashed line, and that's what you get here. So that shows basically the cycle component of world trade. And then, again, we will standardize all that to get the same unit as the one we need for the global financial cycle. But the interesting point here is that when we combine the two series, we see that actually they tend to co-move together. They have a rather strong co-movement. And that was somehow, to be honest with you, a kind of surprise when I started that empirical investigation, because I didn't expect the two series to be so close. And in a sense, it is quite interesting to already look at those empirical findings. Now, you can see that there are some periods, especially before the global financial crisis, when the two series tend to increase together. Then at times of crisis, after the global financial crisis, the two tank pretty sharply, then they rebound. Then there were, at the time of the euro crisis, maybe not that much strong movement, but then again, the two series tended to move rather closely together. And in a sense, and that's for us, the key motivation of our research is that it's not only happening during financial turbulence, like after the COVID crisis or the financial crisis. And Yeah. But it also happened, for instance, between 2016 and 2018, that the two tended to move together. So clearly there seems to be some strong interlinkages between what is happening in the financial world with what is happening vis-à-vis the real trades. And now, moving back to what is actually behind the global financial cycle, as I told you already, there are basically three main dimensions that can explain its movement. The first one is linked to the exchange rate, and mostly the exchange rate, given the prominence of the dollar, is the appreciation or depreciation of the US dollar vis-à-vis the other currency. The second is linked to the monetary policy of leading central bank, and again, here it mostly relates to the policy of the Fed, though sometimes what's happening at the ECB also play a significant role. And finally, the last dimension that interact with those the two other two that I mentioned is linked to the risk aversion in financial actors that is perceived in the financial market, and that is usually captured by what is called the VIX index, or the fear index. Sometimes it's also say. But in short, I mean, the whole idea is that, and that's why you have what is happening in the financial sphere on top, that we believe will have a real, effect on what's happening in the so-called real economy, meaning for world production, but also for global trade. And so I don't want to enter too much into the detail, but what we did next is to look at each specific dimension through what is called a vector autoregression model, and to see when we shock basically our system, how world trade and global industrial production have reacted historically. And clearly, what we observe is that world trade tends to be more sensitive than global industrial production, though what is emphasized in this slide is that when you have an increase in risk aversion in the financial market, it tends to basically decrease or to slow down global trade flows. And as you can see, I mean, on the horizontal axis, you have the number of months after the certain shock takes place. Here is just the shock is conceived as a 1 unit increase of the VIX index, but it's the effect seems to last for quite some time. Now, we can repeat that experience to then analyze what's happening when you have an appreciation of the US dollar, and to capture that particular effect. And there again, the empirical result suggests that when you have an increase of the dollar, it tends to diminish or to negatively affect the trade flows, and also to a lesser extent the global industrial production. Now, what we did next is to try to look at to dig deeper and to see if there were some region in the developing world that were probably more affected by that link, and also specific segment of world trade in terms of the product that are shipped through in maritime transport. And what we observe is that from our data is that it's mostly manufactured goods that tends to be, strongly correlated with the global financial cycle. And as a result, export from Asia and the rest of, from China and the rest of developing Asia are also among developing countries tend to react more to what's happening in the financial world. That just to say that, okay, for Africa and Latin America, maybe they tend to be more immune, but also remember that as your country try to move out from commodities and all that, there is a risk that your manufacture trade might be more affected by what's happening in the financial world. And but I see that my time is running. So in a sense, all that, the analysis that I presented above identifies, common pattern between the global financial cycle and merchandise trade flows. A more granular analysis confirmed that increased financial volatility and the appreciation of the dollar both coincide with diminished trade flows. So clearly, we believe it's important to strengthen research in this area because there is clearly a need to better understand how the global financial cycle and also all the financial channels more broadly affect trade flows. If we ignore those financial drivers that might leave trade vulnerability unexplained and unaddressed, at least for some of them. Now, there are suitable alternative measures which are required to recognize and to counter the adverse financial impact. Some of them are the macro-prudential tools that could mitigate basically the pro-cyclical and the global factors harming the external sectors of domestic economies. However, when the objective of devising proper instrument for that, there is we believe it's important to move from the macro to at least the meso level to understand what's happening in sector-specific aspect of the economy. And clearly, further analysis could probe why some firms might find it harder to access trade finance, and also due to product-specific risk, contract liquidity, or destination market. And so there is a need for conducting such as exercises at the sectoral or national level, but also maybe sometime across region blocks. And in short, and that's the final word, understanding the trade finance nexus is not just an academic exercise, but also a policy imperative where probably multilateralism could play an important role, although policymakers can also push for some exploration to be conducted at the domestic or regional level. And happy to now take questions on the material I presented. I hope it was not too technical, but thank you.